everyone for coming out. I'm excited to be with you this morning and start us off with an economic outlook. So it stands to be another interesting year. So we came into 2025, I think, with a lot of momentum in the economy, GDP growing above, I think, where most economists would consider is its potential rate. We're seeing inflation come down, still relatively high, but at least moving the right direction, and that had finally allowed the Fed to at least dial back somewhat how restrictive current monetary policy is. But of course, as we've moved through the first part of the year, we've had a lot of policy changes afoot, and so that's in many ways kind of scrambled the outlook, put a lot of questions around where the economy is headed as we move throughout this year and into 2026. Now, I think some of the changes that are afoot are going to be good for growth eventually. So when you think about, for example, the tax bill working its way through Congress, also just some of the deregulatory efforts that we're seeing as well. But some of the other changes that we're seeing, I think, can stand to be more growth negative here in the near term. So, you think back to some of the efforts to curtail spending cuts early in the year, what that did to things like consumer confidence. But then now, of course, what we're seeing with trade policy. So when we look at the outlook, I think there's some tricky terrain we have to navigate over the next 6 to 9 months or so as we kind of face some of those more growth negative aspects first, before we get to some of the growth positive as we move into 2026. So that's where the title of this comes from, Just Keep Swimming. We just kind of have to keep going over the next 6 to 9 months or so. So I've got young kids, we watch a lot of Nemo these days, and Disney in general. So Rod, that was Timon, actually. As we move through the year, we've got kind of this tough patch we'll talk about, but then I think there's some upside that we see going into 2026. All right, so let's dive in with, I think, what is really the most pressing topic that I'm still getting the most questions on when I talk to clients and investors, and that's what's going on with the trade picture. So we're seeing, obviously, a lot of different headlines coming out, it seems like every day, sometimes every hours, in terms of just changing policy, in terms of what different rates are, different products, different countries. Do we have a deal? Do we not? What are they concluding in London, et cetera? But I think when you step back and you look at where we are today, it's just important to note that I think wherever we land and whatever we're looking at, even in these whipsaw of headlines, is you're going to be seeing an average effective tariff rate. So essentially that additional cost of imports coming into the country, much higher than where we were just a few months ago. So our estimates right now of where policy stands as of today says that that's a little under 15%. But when we look at what we're at heading into the year, so it was a little over 2%. So this still leaves us with the highest tariff rate that we've seen going back to since the late 1930s. And I'd also highlight that unlike 2018, 2019, this isn't just targeted, mostly at one country or just a few products. So this is much more widespread. So that's how you get that much higher rate, is that, it's harder to hide or harder to transship. And so you're facing a vastly different cost structure for a lot of companies. And I think that's thrown a lot of questions over, not just companies who are directly in the crosshairs of tariffs, but how does that filter through to other parts of the economy for even companies who aren't directly affected by tariffs? What is their end consumer demand going to be if consumers are getting squeezed in other parts of their wallet? So I'd say, right now it's an evolving situation, but we're already seeing this begin to affect activity. So we saw in the first quarter a big rush to get goods inside the country before tariffs hit. So while we, maybe didn't know the exact rates, and again, they're changing almost daily, it seems, but it was pretty well foreshadowed that there would be higher tariffs. So we saw this big move of imports in the first quarter. And so that led to a big drag in GDP growth. So you actually saw GDP contract in the first quarter. This doesn't mean that consumers stopped spending, businesses stopped investing. This was just more GDP accounting. But now we're beginning to see the other side of that. So we saw the biggest drop in imports in April that we've seen in history. So it was even about twice as big as what we saw in the initial parts of COVID, when global trade basically shut down there temporarily. So that's probably going to lead to a spring back in GDP here in the second quarter. But we're seeing similar dynamics play out in terms of things like consumer spending. So really strong sales in March, really weak sales for goods in April. So the point here is that there's going to be a lot of volatility in the data over the coming months. It's going to kind of muddy the picture of what we're seeing in the underlying economy. And while it seems like, okay, we haven't settled on the tariff position yet, it's already beginning to affect activity. All right, so what are the ways we could see this move through the economy? Well, it's important to remember that, there we go, cutting out again. It's important to remember that tariffs are, they are an import tax. So by design, they're aimed to raise prices. One of the goals is to help domestic manufacturers, and so do that by making those domestic products more competitive with global products by raising the prices of those imports. And so when you see higher prices, that is likely to be inflationary. So businesses to some extent will pass on those prices. Now we've seen pretty limited price pass through so far. So if you look at certain categories of like the consumer price index we saw yesterday, you are seeing some goods components beginning to pick up, and that's been one of the areas where you've seen the most firming in inflation. But at this point, it hasn't been enough to, I think, fully offset that disinflationary or that slower trend that we've seen in inflation that's coming from services inflation still cooling down. So this is seen in areas like the housing market, some other parts, like motor vehicle insurance, things like that. But in some ways, the services side has actually gotten kind of, the slower rate of inflation has actually gotten a little kick from, I think, some of the tariff uncertainty, where one of the fastest areas you've seen prices decline is actually in travel. It's just, I think there is more questions over discretionary spending and consumer confidence. So thus far, we haven't seen a big inflationary impact from tariffs, but we do think as some of the inventories that companies pulled forward earlier in the year get run down, as maybe businesses are trying to shield their customers right now from passing on those prices, kind of waiting to see where rates settle. But as this environment goes on, it's going to be harder and harder to shield those customers. So we do think inflation is going to pick up as we move through the year. So we put out a revised forecast yesterday, and so probably looking for core inflation, which is what the Fed uses to measure against their 2% benchmark, going from around 2.5% to 3%. So this is not pandemic inflation, as you can see, but it's also just another year essentially elongating how fast or how long it's taking the Fed to get back to their 2% target. So it's really not what the Fed needs at this juncture when they're still in a multi-year fight and trying to get inflation back to its target. Now, if firms aren't passing on those prices, so that means that they're going to need to absorb them in margins. And so the good news is that goods-related companies are in a relatively good shape to do that. So this chart shows profit margins across the retail, manufacturing, wholesale. So you can see through the supply chain, they are higher than what we were looking at in the 2010s, even around the 2018 trade war. But of course, they need to be, just given the magnitude of tariffs. So it does seem like there's some room to absorb that initially on, or at least part of it. If you look at some of the business surveys, it comes out to about businesses just saying that they're going to pass on about half the cost of tariffs. So we do expect to see some margin squeeze. Now, the thing there is, though, if companies are seeing their profits squeezed, well, that means that there's less money to turn around and invest back in their business. The uncertainty part of this doesn't help in terms of that investment outlook either. So the fact that we still don't know where some of these tariff rates are going to land when we're more than 2/3 of the way through the 90-day pause on the broad-based reciprocal tariffs. It's really hard to make big investment plans if you don't know what your costs are going to be or how competitive your goods are going to be in 90 days, 6 months, etc. So what we're seeing, not surprisingly, is a big pullback in investment plans. So this chart shows investment plans for both small businesses, that's the red line there, but also just manufacturers, as they're really waiting to see kind of how things shake out, and not just from the tariff front, but I think what the broader economic outlook is going to be. So we think business investment is going to be one area of weakness as we move through the back part of the year. We already saw in April the biggest drop in core capital goods orders that we've seen in about 2 years. So already seeing that pullback kind of begin to feed through some of the hard data. Now, for businesses too, so you might pull back in terms of your capital spending projects, but if you're not really sure what your profitability picture is going to look like too, you might also pull back on hiring, or at least not want to make any big decisions when it comes to investing in your payrolls and kind of staffing up at this juncture. So we've seen overall hiring decelerate, so still not too bad. We've averaged about 135,000 jobs over the past few months. So So not collapsing by any means, but there's some trouble when you look underneath the surface. So one, as you can see a bit in this chart, is that while we're still adding a decent number of jobs, the breadth of industries adding jobs has narrowed pretty significantly. So over the past year, about half the jobs have come in healthcare and social assistance. So you're not really seeing hiring in a lot of the more cyclical industries. That can be self-reinforcing. For broad-based job gains, that means broad-based income growth that people can go turn around and spend. So that's one caution point. We're still seeing demand for new workers slow. If you look at things like job openings, job postings, small business hiring plans, so all indicating that demand for workers continues to slide. So we're expecting payroll growth to slow further. And another thing that we're keeping a close eye on is that it's eerily quiet underneath the surface of hiring. So yes, we're still putting up some net job gains, but if you look at what's going on with actual rates of hiring, so just how many people are actually taking a new job each month, it's at some of the lowest levels we've seen in more than a decade. And so that suggests that businesses are really relying more on just attrition to manage their headcount. So they're not laying off workers, so that's the good news. That's the red line there. But they're just not bringing on new workers at a robust rate. But that also puts us up in a bit of a dangerous situation where if you do see demand slow further, revenue slow further, well, we've already seen hiring freeze. We've already seen that kind of letting headcount kind of roll off. And so if you have to make some adjustments, you've already pulled that initial lever. So that's just something to keep an eye on too. If the layoffs start to move up, this picture could change pretty quickly. Now, with the jobs market softening, we think we'll probably see a little bit further weakening in wage growth and employment costs. So right now, you've seen it come down from where it was at the height of COVID. And I think importantly, it's still strong enough for that it's outpacing inflation, so workers are seeing real wage gains. But at the same time, when you look at where it is factoring in productivity, so remember, businesses don't have to pay their workers, the state don't have to pay workers the same as they're increasing prices. If they're being more productive, businesses can afford to step up pay faster than they're raising prices. So if you factor in that productivity component, you're actually already seeing wages at a place that isn't in conflict with the Fed's 2% target. So in other words, the labor market is not contributing to this higher inflation that we're continuing to see. Now, as we look ahead, as job growth slows, we do think that we'll see unemployment move up a little bit. So right now we're at 4.2%. We think it'll go to 4.5%. Doesn't sound like a lot, especially when you think back last year. We at one point we were closer to about 7 or 8 tenths. Sorry, this is cutting out again. So I'll keep trying, but if it does it again, if I can get the handheld, that'd be great. So we're expecting to move up a little bit. The problem is now, even if it doesn't seem like it's a big rise, we're already above, or we're right around the range of where the Fed thinks is full employment. So if it rises much further, that's kind of more of a danger zone, where last year some of that cooling was actually welcome, where again, labor market at the time was contributing to the upward pressure on inflation, which it isn't anymore. The other more concerning part, if you see the unemployment rise further, is that it's much less likely to just be a function of more workers coming into the labor market. So that was part of the reason why we saw unemployment rise so much last year, is you still had some of that bounce back in participation coming from the pandemic. But now that's starting to level off. You can see on the left-hand side chart. But the other factor too is we're not seeing as much inflows of foreign-born workers as you've seen immigration really tighten up. So if you see unemployment rise in this scenario where the supply of workers isn't rising as quickly either, it's indicating there's more weakness under the surface. So just something to keep an eye on. Okay, so let's switch to the consumer now. So if you've got the jobs market that's weakening, that's going to put some pressure on consumer income. So already we've seen income running below spending, so that doesn't tend well for the current pace of spending getting maintained. So you can see that during most periods, income and spending tend to move in line together, right? So for most households, their spending capability relies on what's happening with their job situation. Now, COVID threw a wrench in all of that, but 5 years later, we're moving back to fundamentals. And so if you get further weakening in income as job growth slows, you're not seeing as quite as fast nominal wages, inflation's picking up, that's going to likely mean that you're going to see consumer spending slow as well. Now, we're just looking for a moderation, so somewhere, close to 1.5% this year. And that's because, the fundamentals of the consumer are still pretty good. So balance sheets are in good shape. You can see that with the debt service there on the left. So that's showing how much current income households are devoting to pay off past purchases. So what that principal payment is, but also that interest rate. So still, particularly when it comes to mortgages, benefiting from when a lot of households locked in those very low rates, and that lowered that debt service. And I'd say even if you look across the wealth spectrum, we've seen some lifts across there, but not surprisingly, you've seen even bigger gains in what we're seeing in upper income households, but the lower wealth households have also partaken in that. So I think the question as we think about spending too, it's not so much a matter of ability for consumers to spend over the back half of the year, but I think there's a little more of a question of willingness at this particular time. So we've seen consumer confidence move lower amid this policy uncertainty environment. And if you look at the savings rate, well, the savings rate is still running, pretty noticeably below where we saw it was before the pandemic. So that's been a factor in why consumers have still been spending faster than income, is they're just not saving quite as much. But I think if you do see some of this uncertainty in the environment persist, you could see consumers pulling back on spending and just see more precautionary savings. So that could be a headwind to the spending picture as well. And then real quick, so just when we dig a little bit underneath the surface, so a lot of the numbers I just showed you were in the aggregate, but we are seeing some signs of more strain in the lower income consumers. We see this to some extent in the delinquency numbers as well. But a lot of that comes down to, we've seen an even sharper slowdown in real income for those lower income households. So wages at the bottom end of the jobs market slowing more quickly, at the same time that your lower income households are also actually facing higher inflation when you look at what's in their consumption basket versus what you see at the higher end. So lower income households, they're more exposed to things like higher electricity prices, higher rent costs, et cetera. And so they're still seeing that higher inflation picture as well. And then on the housing market, I think, so while we're seeing some bifurcation in terms of the income side, we're also seeing some bifurcation in terms of who actually owns a home and when did they buy, right? So if you owned a home, were able to refinance in the period where mortgage rates were, roughly 3%, that's helped lower some of your expenses, where for new buyers getting in, where rates have been, closer to 7 at 1.8%. So that's made it a lot more expensive for those purchases. And it's also contributed to a lot of people just staying put in their homes. That low supply has put upward pressure on prices, even against this mortgage backdrop. And so that's kept affordability at some of the worst levels we've seen going back in decades. So we think that mortgage rates probably not likely to come down quite a bit, but that's keeping that affordability picture at a pretty challenging. And it's to the point where it's also affecting some of the builders too, where rates are, it does make it hard for really the math to work for a lot of people to get into those new homes, especially as the builders are seeing increased construction costs, increased labor costs. And so you've seen inventories pile up in the new home market, and you're beginning to see that feedback through some of the construction trends. So single family homes beginning to lower again, not a lot of activity in the multifamily sector as you saw. Just such a big surge kind of following the pandemic, but that's tightened up a little bit as credit's gotten tighter. And you just had builders kind of waiting to see where the supply situation would be before they began to pick up projects again. Okay, so putting this all together, what does that mean for the outlook for GDP this year? Well, we think we're set for a slowdown as we move through the back half of the year. So going back to some inventory swings we talked about at the front, so that's going to lead to probably some choppy quarters, but we're looking for GDP growth. Estimates we put out yesterday, sorry that's not reflected in this chart, but GDP is slowing about 1% by the end of the year. So that's not a technical recession as far as us, nerdy economists would characterize it, but that would be the slowest rate of growth outside of a recession going back to 2011. So I think, for some industries, some parts of the country, likely seeing that it could very well feel like a recession for part of that. But then, we just got to keep swimming. because if you see come 2026, we do expect a bounce back as I think some of this initial tariff shock fades, but then also as we have some fiscal policy relief coming down the pike. Okay, so let's go more towards that fiscal policy, but before we do that, I do want to talk about monetary policy, because this environment of higher inflation, higher unemployment is putting the Fed in a pickle, to say the least. You know, some might call it more of a nightmare scenario. But when we think kind of how the Fed's going to treat this, you know, basically there are two mandates calling for different policy prescriptions. We think that in this environment that the Fed's probably going to come down on the side of supporting the labor market. So if push comes to shove and it means staving off a recession, I think they're going to be cutting, even if inflation does remain high. Now, part of this comes from, I think, just the nature of this shock. So while the Fed's, I think, very cautious about, okay, look, the pandemic inflation, it did last a lot longer than we expected. It did move higher. They're pretty cautious in, I think, being very confident on this would be a one-off shock coming from tariffs. I think they do recognize that unless tariffs are continually increasing, they're not going to have a continuous inflation dynamic. So inflation should recede as we get into 2026. So we still think the Fed could be cutting this year. So we're forecasting 75 basis point cuts, so 25 basis points at the September, November, and December meeting this year. But that really is contingent on the labor market beginning to show signs of weakness. So if you see the labor market kind of muddle along, maybe unemployment moves sideways rather than up, I think you see some of those cuts get priced out, and expectations that maybe the Fed doesn't cut at all this year. Now, the other caveat is that inflation expectations have to stay anchored too. So I think this is part of the concern, is even if tariffs are really a one-off level shift in the prices, we just went through this really dramatic episode of inflation. If you get yet another year of above target inflation, do you see those inflation expectations begin to come unanchored? Now, we've seen short-term inflation expectations move up. I think that's to be expected just given the policy environment, but it's more about what happens to long-term expectations. So, do they go back to, do they settle back to where they were previously? Now, some of these measures, like from consumers signaling, those may become unanchored, but most measures, and honestly the more credible measures, have stayed pretty anchored, and particularly when it comes to market expectations. So people who are looking at this very, very heavily, putting their money to work in this environment, still think that those inflation expectations stay anchored around the Fed's target. So right now, I think that's still giving the Fed the green light that if the labor market does weaken, that the Fed will be moving in to ease policy. We're not talking about going back to zero by any means, but at least removing the remaining degree of restrictive that you see in terms of their current policy setting versus where most would estimate that neutral is. So they don't need to be also weighing on growth at the same time. I think just some of the policy shock and higher tariff environment is. Real quick on the dollar, so I think just given that expecting some cuts from the Fed later this year and just the weaker growth environment, that's going to continue to put some pressure on the dollar here over the next couple quarters. But as the Fed holds through 2026, growth picks up, we see the dollar picking up as well. And when it comes to the rate environment, so markets right now are looking for closer to 2 cuts before the year is out. So some of the cuts that we're expecting are already priced in, but we expect a little bit more. And so we think there's probably some more room for like the 10-year yield to fall this year. So we're looking for it to end the year at around 4.25%. But short-end rates are likely to fall more, just given that they're more sensitive to what we're seeing in terms of Fed policy. Now, part of the reason that we don't expect long-end rates to fall as much, and why we're still looking for them to remain above 4%, is we have seen a return of the term premium. So essentially that additional degree of interest rate compensation that investors want to have their money locked up for a long period of time. Now, this had kind of disappeared a little bit in the period of forward guidance, where it seemed pretty clear what the Fed would be doing with policy, maybe a more stable policy backdrop. But as we've seen deficits rise, I think more questions over growth and the policy environment, you've seen that come back. So that's contributed to rates staying elevated here over this past year, but also as we think where they're likely to stay in the coming year. All right, so part of the reason that term premium has come back is it is a function in part of, I think, the budget outlook and the deficit outlook in particular. So mentioned, we do have this bill working its way through Congress in terms of some tax cuts and also some spending changes. And if we took it versus current law, so it would increase the deficit over the next 10 years by a little over $2 trillion. But a lot of that's coming from just extending the Tax Cuts and Jobs Act. So basically making sure that we don't see fiscal tightening coming as a lot of those provisions lapse as they were originally written. And so from a growth perspective, it's growth neutral, right? We're not changing things, we're not increasing taxes, we're not lowering taxes from that. Where it gets more interesting is what we're seeing in terms of some of the new tax cuts and the spending changes. So the way those are written, so over the next 10 years, they would reduce the deficit, but there's a catch. So you can see from this chart that actually early on, they increase the deficit where you get a lot of the tax cuts more upfront and some of the spending and the pay-fors kick in the back half. So you really have to assume that, well, politicians will allow some of the tax cuts we're seeing now to lapse, so effectively allowing a tax hike to go through back in as we get later on in the decade and into the 2030s. So as we saw from the Tax Cuts and Jobs Act, that's a hard pill for the politicians to swallow. So I think that's where some of this uncertainty over the budget outlook and kind of that demand for additional term premium that's leading to higher rates comes in. Now, there is some offset, we think, to what's happening in terms of the near-term budget, the near-term increase of the budget deficit, where that's going to help, well, it's raising the budget deficit, it is likely to feed through in higher growth, but that's offsetting what we're seeing from a deficit perspective, some of the tariff revenue. So the tariff revenue doesn't get counted in the reconciliation bill, but when you look at the budget and the deficit at the end of the day, it is a potential offset. So already we're seeing those additional tariff revenues come in, and we think that if the policy that we see stays in place, you're probably going to be looking at an additional $240 billion worth of revenue next year, which is more or less offsetting that cost of the increased deficit spending next year. So when you put that together, though, that still leaves us with a deficit that's hovering around 6 to 7% of GDP. So it's still pretty large considering we're not in a recession, we're not in a war right now, and really looking like we'll be there as far as the eye can see. And that really comes down to the composition of spending, and that where a lot of the discussions over what we're spending or not is really focused on some of the discretionary side, but discretionary is only about 25% of the budget, and that's a portion that's actually shrank over the past 5 years when you look at it versus 2019. So really what's been driving the bus, it is that mandatory spending, so some of the entitlement or the eligibility rule-based spending, so things like Social Security, your major healthcare programs, that's been the big driver. But increasingly too, it's also what's happening in terms of the interest rate expense. So we've seen over the past 2 quarters, so the first half of fiscal year 2025, interest expense is now actually outpacing defense spending. So as we see that stock of debt continue to rise with that 6% or so deficits each year, and also just investors requiring that additional term premium, you're seeing those interest outlays are projected to continue to grow as a share of the budget. So, where does this put it in terms of are we headed for a fiscal crisis? I think it's really hard to say. There's not a magic tip point, but the point is that we're raising the cost of capital now, as you see Treasury rates rise in this environment of more debt, and so that's raising the cost of private borrowing. But then also as that interest rate component climbs too, it's meaning that you're spending on that interest component rather than arguably more productive forms of government spending. So not necessarily a crisis, but I think you're seeing some erosion in terms of the fundamentals under the surface. All right, so on that super happy note, just kind of wrap it up. I'll put the summary up here. Hopefully you guys can see that okay. But I think we should have some time for questions if you guys have any. Yeah.
Jamie Dimon said the bond market is going to crack. What are your thoughts on that?
I mean, I'm not one to argue with Jamie Dimon and his seat, but he also said it could crack 6 months to 6 years from now. And I think that's the big challenge for investors, economists, is we see The health is not good right now when you think about the trajectory. So the debt as a share of GDP, it's set to surpass even where it was in World War II by the end of the decade. So that's, we're already halfway through fiscal year 2025. So that's just in a couple years that's going to happen. And I think we're starting to kind of see some of those cracks again with that term premium and rise, investors getting a little jittery about, holding this debt for such a long period. And so it's hard to say exactly when something will happen, but it does seem like there's finally some investor pushback in terms of the situation, but it doesn't seem like there's an immediate response coming from the politicians in terms of maybe addressing some of the underlying trajectory that we're seeing right now, or at least not enough of them looking at that.
You described the federal funds rate is currently restrictive. What's kind of the view on what the neutral rate is?
Yeah, so good question in terms of what's the neutral rate for interest rate, and it varies. So we would probably peg it somewhere closer to 3.25%, 3.5%. If you look at where Fed officials are saying it, they're closer to 3%. So it's been kind of it's been creeping up higher. And the problem with neutral is you don't really know where it is until kind of after the fact. So as we've seen the economy, I think, continue to grow pretty healthy, pretty well in this environment. So again, end of last year we ended up GDP up 2.5%, so above where we would think potential is, even as we had rates, over 4.5% for most of the year. That's implying that neutral rate is higher. There's a couple different Fed models. One of them says it is probably closer to 5%, but then you have another one which people tend to look at, or at least put more weight on, and it's still saying that it's probably somewhere closer to just 2.25. So there's a lot of variation. And that's in part why the Fed's going slowly in this environment, is that they don't quite know how restrictive they are, but if you're looking at an environment where growth is beginning to weaken, I think they will lean on some of those models and assumptions, and most of them are still pointing to at least modestly restrictive. Other questions?
Is AI being factored into the labor market? Decrease in labor could be offset by AI?
So I think, our forecasts are pretty short term, as you can see. So right now we're only forecasting to the end of 2026. So they don't really take into account, I think, major disruptions from AI. We are thinking about it more in terms of potential growth, what maybe that means for the neutral rate of interest, but I think it could still take a while for those changes to be seen. You see a lot of companies kind of playing around with it, but haven't really seen, I think, wide-scale changes in the jobs market yet. And one thing we've been looking at is, while it's a lot easier to kind of pinpoint what some of the new AI technology can do in terms of existing workers' functions, it's harder as we look out, okay, well, what new jobs will be created from those, whether directly from that industry or because maybe as that's helping raise worker productivity, they have more discretionary spending to spend on other industries where it's maybe on other forms of spending where maybe AI isn't as directly impacted. So, more leisure, hospitality, that sort of thing.
At what point should we stop worrying about the value of the dollar comparing to other countries?
Yes.
Can you repeat the question?
Sure, yeah, so the question was, at what point should we worry about the value of the dollar versus other countries' currencies? So right now we're still in a very good position, so I think it's whittled away a little bit as, again, just some of the policy uncertainty. I think also some of the weakness in the dollar we've seen, and even upward pressure on rates, has come from other major economies. They're beginning to spend more in terms of their budgets as well, and so that's essentially allowed other assets to invest in, so that's pulled away some capital here in the US to an extent. But I think in terms of the dollar's reserve currency as a reserve currency status, I think we're still a long way from it being replaced, but that doesn't mean that you can't see, I think, other countries or other currencies begin to take a little bit more share of that. So whether it's the euro, even the renminbi to an extent, but I think you look at what makes a reserve currency. It's you need open capital systems, you need independent monetary policy. The U.S. is still what has that, and of course the market's a lot bigger than other currencies like the euro that has that, where the U.S. market's about 10 times bigger than what you're seeing in terms of the European sovereign debt, or like Germany's, which is the biggest bond market in Europe. So still, I think in an okay position there, but maybe seeing some of that whittled away a little bit, as there are questions about the long-term trajectory and sustainability of U.S. debt and just the overall prospects of the U.S. economy relative to other places.
Follow up on that. Comparing, let's say, the United States growth rate versus the global economic growth rate, historically the U.S. has always outpaced them. Where do you see the short-term, the mid-term forecast as it pertains to us versus them?
Yeah, so so the question was, how does the U.S. Growth rate and just potential GDP really stack up versus other economies? I'll answer that versus other advanced economies, because I think that's a little bit more apples to apples in terms of like where we are in our technology. And I think the U.S. is still very favorable. So in addition to having stronger productivity growth and still being the leader in a lot of the innovation that we see, we talk about Gen AI and beginning to shape the landscape. A lot of that's coming out of the U.S. So, and you tend to see that implemented faster in the U.S. So that bodes well from the productivity side of potential growth for the U.S. And the population side is still pretty favorable when you compare it to a lot of advanced economies. Now, I think the changes in immigration that we're seeing throws a question over, the extent that that continues. But right now, you're still looking at an environment where you actually still have native population growth here in the U.S. Immigration's been a big augmenter to that as well. So when you think about potential growth being a factor of productivity growth plus labor force growth, we're still in a relatively good position compared to a lot of other advanced economies, and even in some cases emerging markets that are having their own kind of labor force and population growth is not as strong as it was in previous decades. So still pretty good, but I think going back to some of these questions about like the dollar and reserve currency, it's maybe not quite as exceptional as what we were looking at maybe a year or so ago with just some of the changes. All right, well, if we don't have any other questions, thank you very much, and we'll pass it on to the next session.
We're given a minute. I know we have people